Sarah got the envelope in the mail on a Tuesday. It was from her car insurance company. She had been with them for 7 years. No accidents, no claims, not a single speeding ticket. She had been, by every measure, their ideal customer. She opened it, expecting the routine renewal notice. Her premium had gone up $340 a year. No explanation, no letter, just a new number, quietly higher than the one before. She called the company, spent 22 minutes on hold, and when she finally got a human being, she asked why. The representative said something about regional rate adjustments and market conditions. Sarah said she was thinking about switching. And here is where it gets interesting. Without a pause, without checking with a supervisor, without doing anything except typing on a keyboard for about 4 seconds, the representative offered Sarah a rate $290 lower than the renewal notice. Just like that, the discount had existed the whole time. Sarah just had to threaten to leave to unlock it. She had been overpaying for years, not because she had bad insurance, not because she made bad decisions, but because she was loyal. And in the modern consumer economy, loyalty is not rewarded, it is monetized. Sound familiar? My name is Isaac, and I spend way too much time thinking about the hidden systems that quietly extract money from the people who play by the rules. If you are someone who pays your bills on time, stays with the same companies for years, and somehow still feels like your money disappears faster than it should, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. By the end of this video, you are going to know 3 things. First, exactly how much the loyalty penalty is costing you every single year. And the number is going to surprise you. Second, the documented reason why companies do this that they will never tell you directly. And third, the exact phone call script that gets you the discount they never advertise. Keep watching, because the third one is where the money actually is. Here is the thing. We have been raised to believe that loyalty is a virtue. You stay with the same bank because they know you. You renew with the same insurer because switching feels like a hassle. You keep the same phone plan because it works fine. This is good behavior. This is how responsible adults operate. Except, the companies on the other side of those decisions have run the numbers. And the numbers say something that should make your blood boil. Your inertia is worth more to them than your business. Think about what that means. It means the company has already calculated that you are unlikely to leave. And because you are unlikely to leave, they do not need to compete for you. They only need to compete for new customers. So the best rates, the best deals, the introductory offers, those are not for you. Those are for strangers. You, the loyal customer who has never missed a payment, who has filed 0 claims, who represents pure profit, you get the price increase. It is not incompetence. It is a deliberate, documented, and highly profitable business strategy. And it has a name. Economists and consumer researchers call it price optimization. But the term that really stuck came from the UK's Financial Conduct Authority, who in 2018 studied this across insurance, banking, and utilities. They called it simply the loyalty penalty. And what they found was shocking. Loyal customers were being overcharged by an estimated £3 billion per year. Not by accident, by design. A customer who had been with the same home insurer for 5 years was paying, on average, 70% more than a new customer buying identical coverage. 70%. For the exact same product. Let that sink in. Now, I told you the number this is costing you per year would surprise you. I am going to show you that math right now, and I want you to add this up as we go, because the total is one of those figures that once you see it, you cannot unsee it. Let's start with car insurance. The average American pays about $1,700 a year. Studies from the Consumer Federation of America have found that long-term customers are routinely charged 20 to 25% more than new customers for equivalent policies. That is a loyalty penalty of roughly $340 to $425 a year on a product where your risk profile probably has not changed at all. You are the same driver. You have the same car. The only thing that changed is how long you have been there. Then, there is home insurance. Same dynamic. Average premium around $1,400. Long-term customers typically overpay by 15 to 20%. Another $210 to $280 a year, disappearing for no reason other than you stayed. Now your internet and cable bill. You signed up at $79 a month. Your promotional rate ended 12 months later, and your bill became $120. You noticed, felt mild irritation. and did nothing. Because what are you going to do? Spend an afternoon on hold to save $40? Except that $40 a month is $480 a year, and the new customer deal for your exact plan is probably still $79. The company will give it to a stranger tomorrow. They will not give it to you unless you call and threaten to leave. Your phone plan, your streaming services raising prices $2 or $3 a year while locking in new subscribers at introductory rates. Your gym membership that has auto-renewed for 4 years while new member specials sit on a banner out front. Your credit card sitting at 24% APR because you never called to ask for a rate reduction, even though cardholders who call and ask get reductions about 70% of the time. Let's add it up. Car insurance loyalty penalty, $380 a year. Home insurance, $240. Internet and cable, $480. Phone plan, $180. Credit card interest at an unreduced rate, $300. That is $1,580 a year, almost $1,600, just for not making phone calls, just for staying. But here is where the real number lives. Not in the annual figure, in what that $1,600 becomes if you invested instead. At a 7% average annual return, $1,600 invested every year for 10 years is approximately $22,000. Over 20 years, almost $66,000. Over 30 years, the length of a typical career, it is $151,000. $150,000. Not from some complicated investment strategy, from simply paying the rate that new customers pay. Now here is where most financial channels will tell you to just switch providers every year. And that advice sounds completely reasonable, but there is a problem with it that nobody talks about, and it actually makes the loyalty penalty worse if you do it wrong. Give me 2 more minutes, because the fix is simpler than you think, and it starts with one specific phone call. The companies that deploy price optimization run on one key assumption, that most customers will not call. Research suggests only about 20 to 30% of customers actively shop their rates in any given year. The company is betting on your inertia. The moment you demonstrate that you're in the 20 to 30%, the math changes for them completely. You are no longer a passive revenue stream. You are a retention problem, and retention has a budget. Every major insurer, carrier, and utility has a retention team whose sole job is to keep customers who are about to leave. They have discretion to apply discounts that the regular customer service rep on the general line does not have. The discounts Sarah got in 4 seconds. That was the retention team's budget being unlocked. Your job is simply to get to that team. So here is exactly how you do it. And I want to be specific because the wording of this phone call matters more than most people realize. You do not call to complain. You call armed with a competitor quote. Spend 20 minutes online getting an actual rate from at least one competitor. This is not a bluff. This is research. When you call, you say exactly this. I have been a customer for X years. I have another quote here for Y dollars less. I would prefer to stay, but I need you to match it or I am switching today. The word today matters. Vague dissatisfaction gets you nowhere. A decision with a deadline gets you the retention team. Now, you might be thinking, Isaac, I tried this once. They did not budge. And I get it. But here is the part that changes everything. And it is the reason most people fail at this negotiation. Be willing to follow through. The system works because companies know most people are not serious. If they counteroffer with a small reduction and you accept immediately, they know they have you. If you say that does not get me close enough, I am going to go ahead and switch. Watch what happens. About 65% of the time, according to customer experience research, they will come back with something better. The second thing most people do wrong, they do this once and stop. The loyalty penalty resets every year, so the fix is not one phone call. It is a system. Put a recurring reminder in your calendar. Every 12 months, before your renewal date on insurance, before your promotional rates expire, shop the market. Not because you definitely want to switch, because the act of shopping resets your leverage. Companies know which customers shop and which ones do not. The ones who shop get better treatment over time. The ones who never shop get optimized. Now, I want to address something, because someone in the comments is going to say it. There is nothing wrong with the companies doing this. Legally, ethically, they are not deceiving you. They are offering you a price, and you are accepting it. The loyalty penalty exists because we let it exist, because we treat switching as an inconvenience rather than a financial act. We would not ignore a $1,600 line item anywhere else in our budget, but because this money leaves in small monthly amounts, because no single bill says loyalty surcharge $32, we never see the full number. That invisibility is the product. Here is what I want you to take away. The loyalty penalty is not a problem you solve once. It is a discipline you develop. Your car insurance is not $1,700. It is a starting point for a conversation you should be having every 12 months. Your cable bill is not $120. It is the price they charge people who do not call. Sarah got $290 back in 30 minutes. She did not switch. She did not even have to switch. She just had to be willing to. That is the entire game. Stop being loyal to companies that are not loyal to you. Be loyal to the number in your bank account instead. That number, unlike your insurer's retention budget, is actually on your side. If this video made you pick up the phone this week, smash that like button and subscribe to Money Explained Easy. I will see you in the next one.